You know that feeling when you check your bank statement, looking at your interest earnings, and you wonder, wait, how did the government manage to take a slice of this before the money even officially landed in my account? I mean, it almost feels like magic, right? But it's actually not magic at all. It's a highly specific, strictly enforced legal mechanism. And today, we are going to unpack exactly how that whole process works. Welcome to today's Explainer. We are going to be demystifying Section 194A of the Income Tax Act 1961. Essentially, we're decoding the precise rules of tax deduction at source, what we all know as TDS, on your bank interest. We are going to take all that complex legal jargon, break it down, and turn it into clear, actionable knowledge so you can understand exactly what is happening with your hard-earned money.
Okay, let's dive right into this. Here is our roadmap for today. First, we'll cover the basics of Section 194A. Second, timing and tax rates. Third, important threshold limits. Fourth, defining key terms. And finally, we'll look at some real-world banking scenarios. All right, let's kick things off with Section 1, the basics of Section 194A and its core rule.
So, what does this section actually cover? Well, the scope of Section 194A is very specific. It applies to TDS on interest other than interest on securities. So, to be clear, the government isn't targeting your government bonds or corporate debentures here. Instead, this rule goes directly after the interest you earn on everyday things, like your fixed deposits, your recurring deposits, or unsecured loans. If a specified entity, like your bank, credits or pays this interest to you, they are legally obligated to step in, act as a tax collector, and deduct that tax before you ever even see it. Which naturally leads us to ask, when exactly does the bank take this money, and how much are they taking? Let's get into Section 2, timing and tax rates. The exact timing of this deduction is absolutely crucial to understand. The law says that tax must be deducted at the time of credit or the time of payment, whichever event happens earlier. Now, time of payment is super simple, right? It's when you actually get the cash, a check, or a draft. But time of credit, that is where the law gets incredibly thorough. Because even if your bank just credits the interest to some internal suspense account or an interest payable account in their own books, boom, that action legally triggers the TDS. Actually, there is one minor exception. If a bank is using core banking solutions, or CBS, and they're just running their daily or monthly macro monitoring software without constructively crediting your actual account, then the TDS isn't triggered just yet. Okay, so when that trigger finally does happen, what's the rate? For non-corporate resident assessees and domestic companies, the standard TDS rate, anchored right there in the law, is exactly 10%. A flat 10% of your interest is held back by the bank and sent straight to the government. Now that we know the rate, what is the threshold? Let's move along to Section 3, important threshold limits. The good news is, they aren't taxing every single rupee of interest at source. There are protective limits. The general baseline limit is 40,000 rupees. If you earn less than that, you don't have to worry about TDS. But if the entity paying you is a banking company, a cooperative banking society, or a post office, that threshold actually bumps up to 50,000 rupees. And if you're a senior citizen, you also get a flat 50,000 rupee threshold. It's only when your interest earnings exceed these specific limits in a single financial year that the 10% deduction gets activated.
But before we go applying these limits to our own bank accounts, we really need to clarify some legal jargon. Let's look at Section 4, defining key terms.
Let's start by defining who exactly qualifies as a senior citizen here. The crucial point to remember is, for the purposes of these specific tax rules, a senior citizen is strictly defined as a resident individual who is 60 years of age or older at any time during the relevant previous year. You have to meet that exact criteria to legally access that higher 50,000 rupee safety net. Next up, we need to talk about time deposits. A time deposit is essentially a deposit that is repayable once a fixed period expires. And here's the kicker. The law explicitly states that this definition includes recurring deposits. So if your money is locked in for a set time, whether we're talking about a classic fixed deposit or a recurring deposit, it is legally considered a time deposit, and the rules of Section 194A apply directly to it. All right, enough theory. Let's see how all this builds together when we look at actual real-life situations in Section 5, real-world banking scenarios. Let's look at our first test case from the source material. Meet Mr. Harish. On October 1st, he decides to make a 6-month fixed deposit of 15 lakh rupees. He's getting an interest rate of 9% per annum with ABC Cooperative Bank, and the FD matures right at the end of the financial year on March 31st. Let's see how the rules apply to him. Let's do the math here. For a 15 lakh rupee deposit earning 9% for half the year, the total interest earned comes out to 67,500 rupees. Now, because ABC is a cooperative bank, his applicable threshold limit is 50,000 rupees. Well, 67,500 clearly breaches that limit, right? As a result, the bank is legally forced to deduct a TDS of 10% on the entire interest amount. So they withhold 6,750 rupees. Now let's look at scenario 2, which introduces a very common strategy people try to use. Mr. Ganesh makes 3 separate 9-month fixed deposits of 3 lakh rupees each, all earning 9% per annum. But to spread things out, he puts them in 3 different branches, Dwarka, Janakpuri, and Rohini, of XYZ Bank. Crucially though, XYZ Bank uses Core Banking Solutions, or CBS. Now here is where it gets really interesting. It's the fundamental difference between non-CBS and CBS banks. You see, if XYZ was an older non-CBS bank, that 50,000 rupee threshold would apply to each branch independently. So Mr. Ganesh's interest at any single branch might safely stay under the limit. But because XYZ uses Core Banking Solutions, the network automatically aggregates his interest across all his accounts in all branches to see if he breaches the overall limit. You can't just hide behind different branch stores. So let's look at Mr. Ganesh's overall picture. 3 deposits of 3 lakh each at 9% for 9 months generates a total aggregated interest of 60,750 rupees across the entire bank. Since the CBS bank threshold is $50,000, his combined interest breaches the limit. Therefore, TDS is deducted at 10% on the full 60,750 rupees. Finally, let's examine scenario 3. Mr. Rajesh decides to go hard and start a 6-month recurring deposit. He's putting away 2 lakh rupees every single month at 8% per annum with PQR Bank. Now remember our earlier definition? Recurring deposits are legally treated exactly like time deposits under Section 194A. And this brilliantly illustrates how the law works in practice. When you calculate the interest on Mr. Rajesh's recurring deposit over those 6 months, his total interest earned comes out to 28,000 rupees. We know the threshold limit for the bank is 50,000 rupees. Because 28,000 falls well below that limit, the result is crystal clear. 0 TDS is deducted. His money remains completely untouched by the taxman at source. So, we've explored the foundational rules, we've looked at the specific tax rates, the crucial threshold limits, and how it all actually plays out in real bank accounts. So, I'm going to leave you with this final thought to ponder. When was the last time you thoroughly checked the TDS deductions on your own bank statements? Because armed with this clear understanding of Section 194A, you are now perfectly equipped to verify exactly why and how your bank is taxing your interest. Keep learning, keep analyzing, and I will see you in the next explainer.